Hello there, healthcare workers, and welcome. Thank you so much for joining us today. I'm Sam, and I moderate these weekly presentations. And in just a second, we will be joined by Michael Corgett, one of our financial advisors. Michael is going to be giving you a rundown of some really useful tips you should be using when filing your 2024 taxes. Before he comes on, though, just a couple housekeeping items. First, I would like you to just quickly be reminded that we are not affiliated nor endorsed whatsoever by any specific healthcare company. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. Second, I apologize in advance. We will not have time today to answer any of your questions live, but I encourage you to still ask away. It's completely anonymous, and I will make sure one of our financial advisors can reach out to you after the presentation has ended to answer those questions with you, either through phone or email. And lastly, while Michael is speaking, you will see some links popping up directly above our heads here. Those direct links will lead you to our calendar where you can book an appointment with one of our healthcare-focused financial advisors, as well as a link to our YouTube and our LinkedIn where you can follow us for much more healthcare employee-related content. We post tons of retirement-related content weekly, and we really think you'd get some value out of it if you considered giving us a follow. And if you do, thank you so much in advance. We truly appreciate it. And with all of that out of the way, let's get started with Michael Corgett.
Thanks, Sam. And thanks everyone for joining us today. Appreciate your time. Today we're going to talk about some tax planning ideas, some minor changes that have gone on in the tax code. The current tax rates that we have today are part of the 2017 Tax Act that President Trump and Congress enacted it during his first term as president. I know that President Trump is going to try and make these tax cuts permanent. Otherwise, they would sunset and the tax rates would go up again. I'm pretty sure Congress is going to go along with him to make these tax rates lower, and we'll get to those in just a moment. But we'll also have a discussion on some strategic planning and preparedness rules and ideas and techniques, making sure that you have a plan. I'll touch on that, and then why you might want to consider working with the retirement group. The 2017 tax rates, we're going to talk about the standard deduction, which does get revised upwards, the marginal tax rates from 0 all the way up to 37%. We'll talk about the benefits of contributing to your retirement plan, your 401k, your 403b, or your 457, and then some information on estate and gift taxes and some various special tax provisions. The married filing jointly standard deduction this year is now $30,000. So for those of you that may have itemized in the past, and you still might want to look at itemizing your deductions, chances are that the standard deduction is going to be worth more than all of those deductions on your Schedule A. I read one time that upwards of 80% of the people that used to itemize their deductions now take the standard deduction. And doesn't surprise me because it is a significant standard deduction. If you're single or married filing separately, the standard deduction is half, $15,000. And if you're a head of household with either dependent parents or dependent children at home, your standard deduction is $22,500. So again, you can try and itemize, but chances are the standard deduction is going to make more sense for you in your as far as filing your tax returns. Now here, you've got the tax tables that start at 10% and then go to 12, 22, 24, 32, 35, and 37. Most of my clients that I work with, married, typically will fall in the neighborhood of the 22% marginal tax bracket. And again, keep in mind, that is the marginal tax bracket. That's the tax on every dollar above that limit. So $96,950 is the beginning of the 22% tax bracket. Every dollar earned under that is going to be taxed at either 12% or 10%. And with that $30,000 deduction, your gross income could be 125,000 plus, married filing jointly, and you'd still fall into just the 22% tax bracket. Even though it's 22%, these tax rates are the lowest that we have seen in a long, long time. So please keep that in mind. If you would like a copy of what we like to call a tax facts table, all you have to do is reach out to our office and we'd be happy to email you one of these. It's got a lot of great information on them and they get updated year after year after year. Marginal tax rates, I already mentioned, the top tax rate remains at 37%. It used to be 39.7%. Adjustments have been made across all the income tax brackets. So cost of living is built into, and those tax bracket amounts do go up. And let's talk about some strategies to reduce your potential tax liabilities. The first thing would be, and probably the smartest and most important one, would be to take advantage of your employer retirement plan. I mentioned 401ks or 403bs or 457s. You can put up to $23,500 a year into your retirement plan on a pre-tax basis. And that is a normal deduction. You don't have to worry about itemizing that. That comes right off the top. So that's the maximum amount anybody under the age of 50 can contribute to one of these types of plans. And I'll say this too. Hopefully you are already contributing to your 401k or your 403b. Make sure you're at least contributing up to the match level that your employer is providing. So in other words, if they match 80 cents on the dollar up to 1%, up to 6% of pay, make sure you're contributing 6% of your pay to get that 80 cents. That's free money. And that you can't make your money work harder than that by getting all that free money up front. All right. There is a catch-up provision for folks over 50. It's $1,000 for deductible or non-deductible IRAs and $7,500 for all other plans. So anybody over the age of 50 could contribute up to $30,000 a year pre-tax. Doesn't have to be pre-tax, but to get the tax benefits, it should be pre-tax. And ironically, this year, they enacted, for anyone who's 61, 62, or 63, they added another 50% to that catch-up provision. So people of those three ages can actually increase their catch-up contribution to nearly $12,000 a year. Required minimum distributions, that's on the other side. RMDs used to be the old 70.5 rule. Well, now for most of us, at the earliest, it's 73 years of age. But for the bulk of us, including myself, RMDs are not required until we're 75 years old. So that is the withdrawal that you have to make from all of your qualified retirement assets, where you have to make one. Chances are you will be making a withdrawal to enjoy your retirement, but if you've had a successful savings period and your investments have done well by you, you might wind up having to take out more than you even need, and that's what the RMD is about. Plus, there are options to take qualified charitable deductions, which can also definitely affect your income taxes for sure. These are also things that are not affected by the standard deduction. This is an additional deduction that can be made. The 2025 estate and gift tax. Well, the estate tax exclusion is still pretty significant. It's almost $14 million. And what that means is that if your estate is under that level, you don't have to worry about any estate taxes. It's called the death tax by many people. There is an annual gift tax exclusion of $19,000. That is per parent. So a husband and wife can double that to each one of their kids or their grandchildren. And it doesn't affect their estate tax exclusion amount. So if you're in a situation where estate planning may make some sense, in other words, you've got a net worth in this neighborhood, we'd love the opportunity to talk to you more about estate planning ideas, as well as that charitable deduction program, the qualified charitable deduction program, that can make a lot of sense if you're charitably inclined. Moving forward, some of the special tax provisions. There's a pretty significant adoption credit of $17,280. Foreign earned income exclusion up to $130 for income earned while you were overseas. Capital gains and capital losses typically you're affected by these in your after-tax investment accounts, brokerage accounts. You can offset gains with losses. You can even offset some ordinary income with capital losses as well. We could tell you more about that in a separate conversation. And then just the impact on specific tax situations. Everyone's situation is unique. Now, many of us fall into some of these standard tax rates, but everyone's situation is different. So it is something that you might want to consider consulting a professional, a tax professional, to help you take advantage of all of the tax deductions that you have coming to you. And a professional can give you those tax planning tips, help you to prepare for tax season, and then just finally we'll close the webinar up with just some final thoughts. I mentioned it, you can leverage increased deductions and exclusions, depending on which year your income, you may have an income where you got a bigger bonus in one year versus the other year. So you might want to push deductions forward versus taking them in a current year. You're definitely going to want to review your investment and saving strategies, especially in taxable accounts. You don't want to generate a lot of additional ordinary income in short-term capital gains versus trying to push that out into longer-term capital gains, which are taxed at lower rates. And you should consult a tax professional. I use a tax preparer that I've worked with for a long time. They are a lot of help. I swear they are worth their weight in gold as far as their fee would be to prepare our taxes. And you know what? They help keep you off the hook. If you do it yourself, and you can with tax preparation software like TaxFax, but you're going to be liable for any mistakes. If you have a professional working with you, they will, obviously, they're also on the hook if a mistake is made. So it is just something to keep in mind. The fee that they charge is worth its weight in gold. So preparing for tax season, which we are in the middle of right now, getting all of your documents organized, it is best to try and do all of this during the tax year, keeping your tax records organized. I personally use Quicken software to keep track of all my deductions during the tax year. That way, all I have to do is print out one report that has all that information already put together, along with my W-2s and my 1099s and whatever other relevant tax documents I need to send my tax professional, and it's done. Just put it in an envelope and I mail it off. Rather than bringing a shoebox full of receipts into your professional's office, or you trying to go through it all on your own. Takes more time. It will cost you more money with a tax professional. So I'd strongly recommend that you stay on top of this during the tax year. Just something to keep in mind, but it certainly makes your life a lot easier, come April 15th. And hopefully you're not waiting that long to get your taxes done. Conclusion, just a recap, there's been some changes this year. There are some benefits, there are some detriments. Again, and the current tax rates and rules, they may wind up going away. We don't know. They haven't made the 2017 Tax Act permanent yet. And I encourage you to be proactive about all of your planning, not just your tax and financial planning. This is, something that I like to say. Everyone should have a plan, whether it's just a retirement plan or a tax plan or an estate plan or all of those combined. And most Americans over the age of 50 don't have a plan. They're shooting from the hip. Take advantage of a relationship with someone like myself and let us put together a complimentary financial analysis for you. It's a complimentary service. It's something we'd be happy to do. We provide these to people all of the time, especially those that are at or nearing retirement. And the people that do plan sooner are going to be better off. But working with someone here at the Retirement Group, we've got a great deal of experience. I've been an advisor for more than 35 years. We have offices nationwide. And for the most part, we've got a very good knowledge of your benefit programs. If you work for a Fortune 500 company, we probably already know about your pension, your savings plan, and your health care benefits. So working with a professional who understands your current benefits is a smart thing to consider. You can send us an email. You could give us a phone call. You can scan this QR code on the left and schedule a meeting with myself, which I'd look forward to, or one of my colleagues. By the way, I'm based in the Midwest. You could schedule or scan the QR code here on the right and follow us on LinkedIn. We maintain a great LinkedIn page with a lot of great resources. You should follow us on LinkedIn. And then finally, you know, I've talked a little bit about a bunch of different things. I'd strongly recommend that if you have questions, you reach out to our firm by calling us again at 1-800-900-5867 or emailing us at info@theretirementgroup.com. Hopefully you got that QR code as well. I appreciate your time, and I hope to talk to all of you sometime soon. Have a great day.